Hey there and welcome. Today, we are going to pull back the curtain on the stock market and dive into something called smart money. We're going to decode the blueprint the big institutional traders use so you can start to see the hidden language that's moving the price on your charts. Let's get right into it. You know the feeling, right? You find what looks like the perfect trade, you jump in, and almost instantly the market turns around, snags your stop loss, and then it reverses and goes exactly where you thought it would in the first place. It's so frustrating. But what if I told you that's not random at all? What if it's all part of the design? To understand that design, we have to start with the absolute basics. I want you to forget all the fancy indicators and complex patterns for just a minute. Because at its core, the market really only does two things. Everything else is just built on top of these two fundamental behaviors. And here they are. First, you have a trending market. This is what we all love to see, right? The price has a clear direction, either up or down. It's moving with purpose. And then you have a consolidating market. This is that choppy, sideways movement. It looks boring, it looks directionless, but believe me, what's happening just beneath the surface is the most important part of the story. So what's the secret behind that boring, sideways action? Well, while most of us are sitting on our hands getting impatient, this is where the smart money gets to work. Consolidation is the phase where huge institutions are quietly accumulating their massive positions. And, more importantly, it's where pools of stop-loss and entry orders, what we call liquidity, start to build up just above and below that range. Okay, so once the market finally breaks out of that consolidation and starts to pick a direction, how do we follow along? How do we read the blueprint of the trend they're building? Let's break down the structure of it. This is probably the most important question for anyone trying to trade with the trend. We need a clear, objective sign that tells us, yep, this move still has gas in the tank. We don't want to be guessing if it's going to keep going. We want confirmation. And that confirmation signal has a name. It's called a break of structure, or just BOS for short. It's incredibly simple, but so powerful. In an uptrend, every time the price breaks through a previous high point, that's a BOS. It's the market's way of telling you, hey, the buyers are absolutely still in charge here and we're heading higher. And of course, the exact opposite is true for a downtrend. Really, you can think of this like the heartbeat of a healthy trend. A break of structure is that steady rhythm. Higher high, pullback, then another higher high. Each time it breaks that previous peak, it's just reinforcing the strength of the move and giving us a clear sign that the trend is alive and well. Now, knowing a trend is strong is great, but we all know trends don't last forever. So maybe even more important is knowing how to spot the very first signs that a trend is getting tired and might be about to reverse. What's the first big warning sign we should be looking for? This is what we call a change of character, or CHOCH. Think about that uptrend rhythm we just talked about. Higher highs and higher lows. Well, if the price suddenly drops and breaks below the last major low that created that highest high, the whole character of the trend has changed. That steady heartbeat is broken. And that is our first major clue that the sellers are starting to wake up. So a CHOCH is the first real crack in the foundation. When that pattern of higher highs and higher lows fails, it's a huge signal that a potential reversal is underway. Now, it's not a 100% guarantee that a whole new downtrend is starting, but it's a massive red flag telling you that the old uptrend is in serious, serious trouble. Okay, now we get to the real secret sauce of smart money concepts. We've talked about the structure, the bones of the market, but what's the fuel that actually powers these huge, explosive moves? The answer, in one word, is liquidity. This quote really says it all. You have to understand, a big bank or hedge fund can't just click buy on a billion-dollar position. The market would move against them instantly. To fill an order that big, they need a massive pool of people on the other side of the trade. That pool of orders, that is liquidity. It's the fuel they need to get their moves going. So where does all this fuel gather? Well, in really predictable places. Just think about how most people trade. Where do you put your stop loss? Usually just below a recent low, right? Where do you put an entry order to catch a breakout? Just above a recent high. All these areas are like magnets for orders, creating these dense pockets of liquidity that smart money knows exactly how to find. And this brings us right back to that super frustrating feeling from the beginning, that sharp spike down that just barely clips your stop loss before the market reverses and flies without you. That was no accident. That was a liquidity grab. Smart money deliberately pushed the price to that level to trigger all those stop losses, creating a flood of selling that they could then use to fill their own massive buy orders. They literally used your stop loss as fuel for their trade. All right, let's put all the pieces together. We've talked about market structure, trend confirmation with BOS, reversal signals with CHOCH, and the hidden fuel of liquidity. Now, let's look at a classic smart money entry model. This is where you see how it all connects. But first, we need one last piece of the puzzle, the fair value gap, or FVG. Sometimes when smart money makes its move, the price moves so fast and so aggressively that it leaves behind a sort of vacuum, an imbalance in price. This gap acts like a magnet, and the price very often wants to snap back into that area to rebalance things before continuing on its way. Okay, here's the full playbook. Step 1, you see the market engineer a liquidity grab, taking out a key low. Step 2, right after, you get a powerful move up that causes a change of character, confirming the reversal. Step 3, that powerful move up leaves behind one of those inefficient fair value gaps. And finally, step 4, the professional entry isn't to chase the price higher, it's to wait patiently for the price to pull back into that FVG. That's your high probability spot to join the new smart money move. So there you have it. That's the basic blueprint. It's a world of structure, fuel, and signals that's happening right in front of us. But now you see the code. You see how the game is played. The real question is seeing the blueprint enough to beat the architects who designed it? That's the real challenge for every trader. Thanks for joining me today.